Okay, to cut to the chase right away, I have in front of you a color-coded list of items with the balance on the right, and it's supposed to help you conceptualize the way that the actual balance sheet is laid out and presented to you. So let's go over this first, and maybe I'll have a few more points to add. So in the green, just for the color coding, like green are items that are assets, okay? Um, they're things that everyone wants to own more of. And this is again from a very relatable personal perspective, okay? So you have checkings account, savings account, some balances in them. Maybe you own a Porsche Cayenne, and 70,000 might not be the right number, but let's just say it was $70,000, and then you own a condo for 500,000, and then on the red is we'll call it liabilities, which is essentially like debt, things that you have to pay. Okay, so some of them you can actually relate back to the asset. You're gonna notice, right? And this is just everyday life. So Amex, your credit card, your car insurance payments every month, and then maybe you have a student loan that's still outstanding, and then a mortgage. Now the mortgage, you're gonna notice that's probably related to the condo, right? And then when you subtract all the red from the green, right? You add up all the green, add up all your assets, and then you subtract. Let's not put it there. Let's put it on the bottom, just so everything looks more succinct. But let's say you take all your assets in A, and then you subtract all your liabilities that are red as L. You get net worth, and we'll call it equity. Okay. So the important thing on this slide is to think of at the very bottom when you have net worth, just think of another name for net worth is equity. Okay. So why do I have different shades of green as well? Well, there's two kinds of assets, and then there's two kinds of liabilities. So this has to do with classifying the assets and liabilities in terms of a word called liquidity. Liquidity, um, when it comes to finance, essentially means how quickly for assets is how quickly you can turn those assets into cash, which is the most liquid asset. Okay, because you can use cash to pay off debt. That's essentially why. And then the lighter shade is higher liquidity, and the darker shades are lower liquidity. So let's take a second to think about this. Balances in your checkings and savings account up here, right? Like those balances, you can kind of withdraw whenever you want and then use them to pay debt. So they're very liquid. Let's use another color actually. Okay, let's use purple. Okay, and then the Porsche and the condo. Let's say you have an emergency and you need $500,000. I mean, the condo you can't sell it in one day. It's probably going to take sometimes weeks to months. So that's going to be not a very liquid asset. And then when it comes to the debt, same thing. Your credit card bill is usually due and payable every month. So is car insurance payments. Whereas your student loan mortgage, like there are like when it comes to liquidity for debt, it's like how soon do you have to pay that debt? Let's say you have the Amex $3,000 due, this month. You have to pay it within 30 days usually when you get the bill. Whereas for the student loan, yes, there's a portion of it you have to pay every month, but the student loan, like the principal part of it, is long term, right? The 10,000, you're not expected to pay the full 10,000 in the next month. You can probably pay it out over several years, or the mortgage usually over tens of years, right? So that is really important to understand that this way that I presented the net worth statement for you is how the balance sheet for a company will also be presented to you. And another important thing to know is that they will also be kind of presented in the order of liquidity, the same way I have it here. So you're going to see the most liquid stuff on top, in the lighter shade is going to be presented first, and then the less liquid stuff. Okay, and the balance sheet does a good job breaking it out for you. So hopefully, once you see this, you can kind of translate it into the next slide. All right, so let's just get right into the balance sheet. And similar to the income statement, this isn't going to be how the actual balance sheet looks like, but we're going to build up into it. So I'm going to start off by condensing everything and then expanding it slowly and slowly. Okay. So first of all, you have some information up here, just like for the income statement. You're going to, first of all, it's going to say that it's a balance sheet. And then the name of the company, and then for the year ended. But one big difference you need to know about any balance sheet is, like for the income statement, the IS, which sometimes we call it this, income statement. When we talk about the income statement and we say it's for the year ended December 31st, it's essentially saying this is how much the company made or how much expenses they incurred over the course of the whole year. But when we're talking about balance sheet, any balance sheet, it's just a timestamp at that moment. Okay. So for example, you can figure out your net worth like on the previous slide. You can do a calculation right now, today, and you can figure out how much net worth you have. But let's say tomorrow, for some reason, let's say you just blow, like in the previous slide, I think there was what, like $10,000 or $5,000 cash in the checking account. Let's say you blow $5,000 in Las Vegas the next day. Your net worth will be different the next day. So keep in mind that the balance sheet is capturing that specific day at that moment in time. But nevertheless, it's still a good kind of comparison year over year of how, how a company's like assets and liabilities, and we call it, there's a term we call it, it sounds really fancy, but it's essentially it's capitalized. How is their balance sheet capitalized? Essentially what this means is like when we think about a person, like, and let's say somebody drives like a BMW, right? And then they wear like Gucci and all this designer clothes, but let's say they borrowed a whole bunch of money to buy those things, so then they have more debt than they actually own of those, luxury cars or luxury clothes. So they mostly just have debt. You're not going to think that they're well capitalized, which essentially means how much, like they have a good net worth is essentially what it means. Like they have, not all their assets are purchased through liabilities. Okay. So, in a nutshell, as some people would say, it refers to how healthy uh, a company's assets and liabilities, how their balance sheet looks. Okay. So right here we have, again, just like the income statement, we have the previous year and the current year. And it's always a good comparison year over year to see how, how to see how things moved. And that's a really foundational piece of analysis, is to compare it with the previous year, right? So the way it's going to be presented to you is it's going to show you the assets first, and then it's going to show you the liabilities, and then the balance sheet will actually do the math for you. It'll subtract the liabilities from the assets and give you the equity. It's going to calculate it for you there. Okay, so when you see positive equity, like this company's net worth or equity is 178,000. Last year was 203,000. So you might be wondering, hey, why? Why did it go down? Well, there's a couple of reasons, and part of that, first of all, you can think like, hey, they have less liabilities, but they also have a lot less assets, right? That's what's contributing to the equity change. But there's another component of it, and the change year over year is driven by the income statement. I think that's kind of a handful to think about, but like let's say you do your, like each of us do our jobs for a year. Let's say we get paid $50,000 a year, right? out of that 50,000, if we spend all of it, your equity is not going to increase because your assets are not going to increase, right? As a matter of fact, if you make $50,000 and you spend and it's not enough and you have to borrow some extra money, your equity will actually go down because your liabilities will go up, because that's what a balance sheet is. A balance sheet is essentially all your equity plus your liabilities here is equal to assets. I should have wrote it the other way around, but this is the equation, and it comes from assets minus liabilities equals equity. I'm just moving the liability to the other side, but this is kind of the equation. You can write it, either direction, but like I just said, if from a personal standpoint, if you make 50,000 a year, you're very frugal with your money, you don't spend much money, your liabilities will not change, right? So we'll call it stagnant, but your assets will go up, which means your equity will go up. But if you spend a lot, you're not going to retain any cash or in your savings account. So your assets might stay the same, but your liabilities, like if you spend so much, you have to borrow money to cover your other expenses, your liabilities will go up, which means your equity will go down. So it's just like it's a balancing act. It's an equation. It always has to equate. And I would recommend thinking about it from a personal level, like I presented to you on the previous slide. Okay, so we're going to expand it one more level up. So you notice previously I just had all the assets, liabilities, and equity. But now notice how we have current assets, non-current assets, also known as long-term assets, current liabilities. Oh shit, that's not the right color. It should be like a lighter shade of red. We'll just use orange, okay? And then non-current liabilities, which is also known as long-term liabilities. Okay, so recall that in the first slide we had the different shades, right, for the personal net worth statement, but now we have a balance sheet. And at the next level, we split up the total assets into current and non-current, and we split up the liabilities into current and non-current. That's all we did. The components, right? So let me get my pen back here. But yeah, so the components here add up into this, and the components here add up into the total liabilities, right? And it's all just a big equation. At the equity level here, it's still just total assets minus total liabilities. All of this is, all the math is done for you. When you look at a balance sheet, it's just subdivided for you. And the next slide is going to look really intimidating because it's going to look really packed full of different line items. But I'm just going to preface it by saying, just like the income statement, what the actual full balance sheet will show is that it's going to break out all the current assets and liabilities and non-current assets and liabilities into these individual accounts, right? Those accounts might be different from company to company. They might be called different things sometimes, but they're just, all it's doing is telling you what specifically that current asset is. For example, in the personal net worth statement, we had like, for example, we had like a Porsche, right? We had a Porsche, and then we had a condo. So those are the specific accounts in the non-current assets. So it's just going to list them out, okay? Now, what is the difference between current and non-current? There's actually a specific qualifier when it comes to balance sheet. So for a company, current assets are anything that can be liquidated into, converted into cash, or is expected to be converted into cash within 12 months or a year. And then non-current assets is anything that will not convert to cash or will take longer than a year to convert to cash. For example, buildings and manufacturing facilities, very similar to the way that I presented it before. And then when it comes to current and non-current liabilities, exactly the same. Current liabilities are things that are expected to be paid and are due within 12 months. Non-current liabilities are expected to be due and paid over longer than a year. Did I say a month back for current liabilities? I mean a year. It's all based around 12 months or a year. Okay. Let's see the full broken out balance sheet. All right, and this is gonna be the final slide. Thank goodness, right? So I actually didn't have enough room to fit this little blurb, but it's supposed to go above here. So as you can see, we still have each of the current assets. You know what I'm gonna do? I'm actually gonna highlight it so that it's to keep things consistent. We have current assets, all of this, right? Current non-current assets or long-term assets, and then we have current liabilities here, and then non-current liabilities here. Oh, I shouldn't include the total, but you do notice that they do total it up for you, right? So I'm gonna go back to my pen, and remember how the net worth we put as like yellow. I don't know if this yellow will show, but I'll try to scribble some yellow here for the equity part. But yeah, let's take blue now. But notice how the current assets, every account, they kind of sum it up for you, right? They sum it up, and then the total assets, they also sum it up. I don't want to block it because you're gonna need the information later. Yeah, you notice how they just sum everything up here? And the same goes for current liabilities, non-current liabilities, so I'll sum it all up for you. So you're really just trying to interpret the information, okay? Let me think about whether there's anything to add here. Well, you notice how like each of the accounts, like cash, GICs for the company, those are things that that can be converted into cash. Well, cash itself is cash within 12 months, right? The one thing I do want to briefly explain right now is the accounts receivable item, and then the accounts payable item. Inventory, you know what inventory is for a company is basically if you're selling chairs, how much chairs you have in the warehouse, right? And then there's some other items like tax recoverable. Anytime you see like the word recoverable or receivable, you can assume that it's a current asset. Anytime you see the word payable, you can assume that it is a current liability, okay? So let me just write that here. Receivable or recoverable. I'm not going to spell it all out because I have to draw with my cursor and it's fucking annoying. But those things are current assets. And then payable, anything payable, you can assume that it's a current liability. Okay, and that's really useful to know because sometimes these recoverable or payable items are so like niche or they're so uncommon that you don't know really what specifically it is. All you know that is all you know is based on whether it's called a receivable, recoverable, or payable, whether it's an asset or a liability. All right. So, yeah, as I was saying, like it's important to understand what accounts receivable is because that's something that doesn't really, it's important to know. So for a company, an accounts receivable is basically if their customer pays them on a credit card, they don't give them the cash right away. It's that becomes an accounts receivable. Essentially, they're paying on credit, and the company can expect payment within the next 30, hopefully within 90 days, but 30 to 90 days. Let's just say, or 0 to 90 days. Actually, the sooner the better, right? And then when it comes to an accounts payable here, that's the situation where the company is the one that's buying something. Usually it's paying its supplier. So for example, like a chair manufacturer, if that company needs to pay for wood to make the chairs, right? So every time it buys wood, it might buy it on credit. So now the company now owes somebody else the payment for the wood within 90 days usually. So that's kind of those two accounts just to understand what they are. I think the other items, let me think, the other items are very, some of the items are hard to understand. Like, for example, anything under non-current assets, like due to and due from, these items we're going to touch on the next video because it's more of an applied concept. But just think right now that they're similar to long-term assets or long-term liabilities. Okay. And then once you subtract everything out, you get here, which is equity, but technically called shareholders' equity. Okay, you're gonna notice usually on a financial statement, there's these little $100 accounts called share capital. What that referring to is like, you know how companies have shares, right? So they usually have 100 shares, and then the way they represent them in the financial statement on the balance sheet is always $100. So it's a bit odd, but you're gonna see those $100 accounts under share capital. What you can assume is that they mean that there's 100 shares, right? That's how they divvy up the company between the owners. Most of the equity comes in retained, something called retained earnings. So what that means is like over time, remember how I said, like, if you make money and you don't spend it, then whatever's left at the end of the year, you're keeping it, right, as your net worth. So you're increasing your net worth or your equity. Retained earnings is like earnings. Remember, earnings is net income, right? That's at the very bottom of the income statement after you deduct all expenses. That is how much you retain. And the retained earnings is a running account. So every year, how much retained earnings do you have left? I guess the reason it's called retained earnings is because you build it from the income statement net income, right? Year after year, you either build it or you lose it. Hopefully that makes sense, but if it doesn't, please reach out and I can explain it in a different way. So on the right side are the only equations you're going to need to know. I know I included right here, EBITDA, right, on the top right here. I included EBITDA from our income statement lesson. I'm just going to restate it here because you're going to need it for one of the equations. So first of all, we have working capital, and the equation is basically just the difference between current assets and current liabilities. That difference is like, let's say the working capital is positive. It means that the company has extra current assets to cover all of their current liabilities. So all the stuff that's due within 12 months, well, they have sufficient assets that can be liquidated or turned into cash within 12 months. So as long as that number is positive, they are good to go. But if that number is negative, it means that they might not have enough. They might not have enough cash in the short term to cover their payments that they have to make in the short term, and that's when they come to us for financing or an operating line of credit because they need some short-term financing to get past that. We call it a working capital shortfall, which basically means negative working capital. So that's what this really means. And then we move on to current ratio. It's essentially, instead of subtracting, you're dividing current assets by current liabilities. It's telling you the ratio of current, like for every dollar of current assets, how many dollars of current liabilities do you have? And it kind of tells you the same thing, like how liquid a company is, but in a different way, right? So typically, rule of thumb is a healthy current ratio is at least 2, but it depends on what kind of company it is. Some companies, it's normal to have it lower, and some it's normal to have it even higher. Can't think of any examples that might be good off the top of my head. Maybe I would say that for, like, how Pokemon cards are really big right now. If you have a company that the business is to kind of buy and sell like these Pokemon cards, then the ratios might be really low because the Pokemon cards aren't really liquid. So those are all long-term assets. You're not going to have much short-term assets, and you might have liabilities to kind of, you might be borrowing money to buy those Pokemon cards, and then the time for you to resell it might be quite long. So maybe that's a horrible example, but that might be a company where the current ratio should be lower. Now, the two at the bottom here, like total liabilities to equity and total debt to equity. So let's talk about the word two, okay? The word two, the word two means divide. Okay, whenever you see something to something, it means the first thing divided by the second thing. So total liabilities to equity is you're just taking the total liabilities, which is calculated for you right here, okay? And you're dividing it by the total equity, which is also calculated for you right there. So you're taking the two numbers and dividing it by each other. Essentially what it's telling you is what is the ratio of like the total debt that the company has versus their equity, or if you want to think about it like for every $1 of debt, how much equity do they have? Obviously, both of these are called something called leverage. Leverage means how much debt a company has. The lower the better, obviously, right? Because the higher amount of debt a company has, the more interest they have to pay. So it can get quite risky. It just means more risk for the company. And then the other thing that we actually use in commercial banking, at least, is total debt to EBITDA. You're taking the total debt, which is different from liabilities. Debt is actually the account items that are legitimately loans. For example, here we have vehicle loans and bank debt. Those are the only things that when you read them, you know for sure they're debt, right? The due to shareholders might not be actual debt. So you have to take the actual like stuff that are legitimately loans that have where like the company has an obligation to pay it back, and then you divide it by EBITDA. Okay, so right here you divide it by cash flows. So what that tells you is, you know, all the debt that you have currently, how many years based on the current cash flow does it take for you to pay off all the debt? In this case, they only have a total debt for 2025 of let's see, 30,000 and 280,000 together is 310,000. But for 2025, they had $356,000 of cash flows. So within 1 year, they should be able to use their cash flows to pay off all their debt. And those are just two different ways that we measure leverage, and we calculate the risk based on the balance sheet. So hopefully that makes sense. I know it's a bit more technical for the balance sheet, and I'm happy to try to explain it in a different way if it doesn't make sense. But those are the formulas I would say that are the most important. The ones in red, I would say, are the only ones that I really use on a day-to-day basis in commercial banking, at least. When we do any kind of testing, when we test a company to see how their balance sheet or how well they're capitalized. And yeah, I would encourage you to pause the video, do calculate the same four ratios for 2024 because the one I presented here is all for 2025. Okay, so if you take a moment to really maybe rewatch it, a little bit, try to do it for 2024, pause the video, and I will show you the answers on the next slide. All right, so hopefully you had a chance to try to calculate those four ratios and then working capital as well. And hopefully you got the right answers here. Let me know if anything seems off. But sorry, this is a bit of a longer video. But there are a lot of nitty-gritty things that I felt like needed some extra explanation so that you feel confident about reading balance sheets. Yeah, let me know if you have any questions.